Welcome to the Cherry Beckert Tax Beat, a conversation about tax that matters.
Welcome to this edition of the Cherry Beckert Tax Beat podcast. Today we're going to be talking about the tax provisions in the proposed budget released by President Biden earlier this month and the related Green Book subsequently released by the Treasury. These are always interesting exercises, but it's even more interesting when we have a divided Congress. So with House and Senate being controlled by the opposite parties, it's highly unlikely that this budget proposal will be passed, certainly not passed carte blanche in its present form, but it is important to recognize that what the president and one party is thinking about from tax revenue raisers can keep showing back up, keep circulating, and they will have a place to play at some point in time. So joining in today's conversation are Ron Wainwright, partner with our tax credits and incentives team, and Brian Dill, leader of our international tax services team. So, Ron, how's it going today, sir?
Going great, Brooks. The sun is out in Raleigh, North Carolina, and we are going to be talking about the proposed president's budget. And so it's great.
And Brian, how's life treating you?
Fantastic, Brooks. Ready to talk about international.
And Brian and I are both in our Atlanta, Georgia office today. And join us, as always, Ms. Sarah McGregor from Greenville. How's life treating you, sir?
Life is good in Greenville, except my NCAA men's bracket is completely busted. And so I have turned my complete attention over to the South Carolina Gamecocks winning the women's tournament.
I would like to meet somebody whose brackets are not completely broken after this year. It's just been a weird basketball season in general, and this tournament just seems to epitomize the chaos that was here all season, right?
Right.
All righty. Well, off with boring basketball, on with exciting tax proposals. So, just as a recast, every year the president presents a budget to Congress. Most of the time it has a lot of spending provisions to achieve the administration's goals, but there's always the revenue raise side, which is typically the tax piece of it. Congress, will receive the budget, and then they will propose their own budget bill, normally starting with the House, but anyway, they frequently ignore whatever the president says. I don't know if they truly ignore it because they know they can't ultimately get something passed unless the president has some consensus built into the process. But anyway, so most of these, what we're seeing now are, I would say, concepts that we are familiar with from the prior Build Back Better proposals by the Biden administration, some from the IRA, the Inflation Reduction Act. We saw some of these. There are a couple of new concepts, but they mainly feel more like modifications or new additions of what we've already seen. So I mentioned earlier, after President Biden and the White House came out with their budget, the Treasury issued a Green Book that has further explanation and scoring. There's way too much in here to cover every provision, much less every tax piece of it, but we'll concentrate on what we can, mainly focusing on the business taxpayers. But so many businesses have pass-through entities, the ramifications on the individual side can't be ignored, and at the end of the day, we're all individuals, so there's also a lot of fun on that. So let's jump in. The first things first. What's the possibility of this budget passing into law, Ron?
So, Brooks, I think you, from a background perspective, said it very well. Most presidents' budgets are negotiated heavily if they, in fact, are ever passed. So as we look at the president's budget for the fiscal year 2024, it outlines several major tax increases that ultimately would bring the U.S. tax rates far out of step with international norms. As you pointed out, some of the proposals that we'll talk about may be familiar to some of our listeners as they are really recycled from prior budgets and failed legislative attempts previously, but some are new. And like the proposed tax hikes for Medicare funding, there is a lot in the president's budget. In total, it would add up to almost $4.7 trillion in new taxes, specifically targeted at businesses and high-income individuals. Going back to a comment I made, I think it's important to understand that the current proposal would put combined marginal tax rates very significantly ahead of OECD averages. So, for example, the top combined marginal rate on individual income would move from 42.8% under current law upwards of 45.4%. When you see OECD averages, which exclude the United States, it's 42.6. So you see that we're above, significantly from 42.6 to 45.4. And then in the top combined marginal rate on corporate income, where we're currently at 25.7%, that really came through the Tax Cuts Jobs Act of 2017, it moves that rate to 32.2% in the budget, where you compare that to the OECD average, again, excluding the United States, OECD averages are 22.8. So where we were already ahead, we are now at 32.2%. So, there's a comment that's been made repeatedly when presidents put forth their budgets, that it's all about potentially political posturing, as the president indicated that his budget would actually decrease our debt ceiling by about $3 trillion. So some comments have been made that very similar to other presidents and consistent with President Biden's former budget, is somewhat dead on arrival.
Yeah, well, Ron, you started talking about some rates. Let's dig into that a little bit. Let's talk about what the proposals are for increasing corporate and individual tax rates.
No, it's an excellent question. As I said, it really raises taxes by $4.7 trillion in new taxes. And again, targeted on businesses and high-income individuals. So, when you think about the corporate, and Brian's going to be talking about our international tax proposals, but, the corporate side, it increases the corporate income tax rate from 21% to 28%. It's about a $1.3 trillion increase of the budget, if you will, from the standpoint of increasing taxes. One item to point out is it quadruples the stock buyback tax, which was implemented in the Inflation Reduction Act at 1%, and it quadruples it up to 4%. When we move to individuals and even some of the pass-through business tax proposals that are in there, it raises the top statutory tax rate on individual income to 39.6% for single filers earning over $400,000, and then joint filers earning over $450,000. So, resets back to pre, 37.5, now upwards of 39.6. It also expands the base of what is referred to as the net investment income tax, NIT, to apply to active pass-through businesses income above $400,000, and increases the NIT in health insurance, or HIE as it's referred to, from 3.8% to 5% above $400,000. A couple other items buried in there was the carried interest. This has been a proposal over many years to go back to ordinary income rates. And then, a number of I'll say real estate provisions that we'll talk about. The other item it does is it taxes capital gains at ordinary income tax rates for taxpayers with income over $1 million. And so, a lot in there for $4.7 trillion in gross tax increases.
And that rate increase to individuals, really lowers that top tax bracket too. If we're dropping that back down from where the 37% bracket is for 2023, dropping that significantly lower to 400,000 to 39.6 if this were to go through.
Correct. And the other item that is in the bill is it actually restricts contributions for individual retirement accounts for taxpayers with income above $400,000. So a lot to unpack in the president's budget for 2024. It also has some significant increases. So in the budget, it actually increases the IRS funding by 15%. Or about $1.8 billion. So they would be spending, or we would be spending as taxpayers, $14.1 billion in fiscal year 2024. And so, again, there's a lot in there to unpack. I go back to my comment that most presidents' budgets are seen as somewhat political positioning. And there have been numerous comments and articles written as well as that this is pretty much dead on arrival. And specifically, it really hurts the United States overall when you compare it to OECD averages and where current law is currently. And as we know, we have an economy that is struggling, whether that's under inflation and or the most recent potential banking crisis.
Right. So on those cherry notes, let's talk about the international side. President Biden continues, I think, to recognize the international pressure on kind of a global minimum tax regime. So, Brian, what are you taking away from this current bunch of recommendations on that front?
Yes, Brooks, I think I'm going to have to echo Ron here in that by and large, if you want to boil it down, President Biden put together, we didn't really put it together, he dusted off the old, as you said, and that's an accurate statement. He really has put together a policy or a political document that essentially is saying, worker friendly. And with regard to, how our balance sheets are today, it's usually intangible property, intangible value. That ability for U.S. companies to go overseas and expand their brand will be greatly hit under these proposals. And the reason it'll be is because it is going to greatly restrict your ability to earn money offshore, keep it offshore. And if you don't, you're going to be subject to a higher tax under what we call the GILTI regime. And I think the biggest thing under the GILTI regime they're proposing is that you would no longer be eligible to just get the 10.5% rate deduction or the high tax exception. You would essentially be at 21%. And if you paid taxes overseas in excess of that, then you would be allowed a foreign tax credit. But, and this is both an administrative burden and a complexity, you would only be allowed a foreign tax credit by jurisdiction. So if you pay taxes in the UK, but you also pay taxes in Germany, those two taxes could not be combined in the same bucket. So it's essentially a mechanism to limit your ability to take credits. So overall, just an increase in the amount of tax on the U.S. side of your international operations is what I'm seeing.
Brian, are these proposals drawing us closer to what the OECD would like to see all countries do, or is this still leave us as an outlier?
That's an interesting question, Sarah. I don't know if I would use the term outlier as much as, certainly with regard to the export subsidies on the foreign derived intangible income, that certainly is in line with what Europe wanted to see. Certainly with the Pillar 2, it is trying to be in line with that, but I think it goes beyond Pillar 2. and is actually increasing, as Ron said, the overall rate on this is not 15%. You're going to be way in excess of 15% on foreign earnings. You're going to have very difficult times at getting a foreign tax credit on this. So I would say from a rate perspective, we will be way in excess of what the OECD is trying to accomplish.
And so one of the other areas that there was changes to, we keep renaming it, but the BEAT tax, the beat of the day, is now something called UTPR.
Yes. So they continue to change the BEAT proposals, and they have they're trying to limit the deductions on that and the interest paid on that to continually not allow you to offset some of those business interest expenses and other BEAT proposals that would essentially make sure, and all BEAT really is for your foreign earnings, it's really an alternative minimum tax. And essentially what they're going to do here on your under tax profits rule is essentially make sure and that's what the UPR is they're going to make sure you're paying sufficient tax on that back in the US, and that you're not able to go to tax havens or other local jurisdictions or through hybrid transactions to avoid paying tax on those type of transactions. So it's a very complicated system, but essentially all they're trying to do is make sure you're paying a minimum tax. And I would assume, and the way the rules are written, that BEAT is going to further drive up under the under tax profits rule. It's going to further drive up the overall cost from a tax perspective.
Yeah.
Now,
Sarah,
I will caution there on the BEAT, those are for taxpayers that have global receipts in excess of $750 million. So for small to mid-market businesses, by and large, the BEAT is not applicable, and it will continue to not be applicable. And the OECD has the same thing. They're a little bit lower at the 500 million euro, but in both scenarios, they're not trying to go after the smaller businesses on the AMT for your international operations.
Sarah, it was my understanding they wanted to change the name from BEAT because our podcast title was creating confusion amongst some of the corporate tax-paying community.
There you go. Yes, those billion-dollar taxable companies were very confused and kept showing up for our podcast. Yes.
All right, Ron, you talked earlier about some proposals on real estate, and again, some of these are retreads. So there's a new curveball or two in there. So why don't you talk about the real estate provisions?
Sure. So as you all have highlighted, when you get to the compression of single to 400,000, and when you get to the compression of married filing jointly at $450,000, it's interesting to see what kind of springs back from an overall marginal tax rate. But one of the areas that was focused on, and this is not the first proposal, was the repeal from a real estate perspective of like-kind exchanges for deferred gains that are over $500,000, and specifically targeting single taxpayers and 1 million for joint taxpayers. So, if you're a $500,000 and for single and 1 million, you would no longer have the ability to use a like-kind or an LKE type transaction. To a comment Sarah made, I think is important is, one of the things that's in the president's budget is it creates a 25% what's called billionaire minimum tax to tax unrealized capital gains of high net worth taxpayers. And so, when you begin to kind of get through all of the analysis, the ultimate top combined marginal rate on capital gains, which is current law at 29.1%, underneath the president's budget springs to 49.8%. And if you compare that to OECD average, going back to my comment on almost dead on arrival, the OECD average is 18.9. compared to 49.8 underneath the current president's proposals. The other thing, kind of to the international provisions, I'd comment is when you think about the combined integrated rate on corporate income, where right now we're at a current law of about 47.3 as you walk through all of the provisions in current law, it springs up to 66%. And if you compare that to an OECD average, it's about 41.4%. And so that kind of goes to my comment with respect to the, when you think about raising taxes to the tune of $4.7 trillion, it really puts the U.S. on a competitive basis at a significant disadvantage. There are changes in cryptocurrency tax rules in there as well, which was somewhat interesting. But going to a comment that Sarah made, a couple of the expanded tax credits and other provisions that were interesting to see, kind of going back to this, high net worth individual to, corporations moving to ultimately, 28% and above, is that underneath the president's proposal, it does extend the ARPA child tax credit for 3 years. So, remember that came underneath the American Rescue Plan, but it makes the child tax credit fully refundable on a permanent basis and creates actually a monthly payment option to the extent that you qualify. It further goes on to permanently expand the earned income tax credit for workers without qualifying children. Those two provisions right there are at a cost of about $600 billion in the president's budget. And then it further, which I would argue is a good furtherance, it does expand the low-income housing tax credit, often referred to as LIHTC, and creates a tax credit for rehabilitating homes in high-poverty neighborhoods. So, from a policy perspective, you can see a significant paradigm shift from a tax rate, a marginal tax rate. When you think about quadrupling the stock buyback to 4%, and then when you talk about, raising the statutory rate on individuals at 39.6%, going back to that 400,000, that 450,000, and then you think about this billionaire minimum tax of 25% on unrealized capital gains. There's a lot of policy targets in the president's budget. Specifically when you think about tax carried interest moving to ordinary income. So a lot of old policies put forth as political positioning. It'll be interesting to see what the next steps are, but hopefully there's a little bit of good news in this budget proposal as well.
So, Ron, I'll just have two quick follow-on comments. One is the, in addition to the low-income housing and that new neighborhood homes credit you mentioned, we also would love to see the new markets tax credit made permanent, which is resurfaced again in this proposal. And then on the real estate side, you talked about the 1031 and the carried interest. There's also some fairly troubling depreciation recapture language in this one too. So again, we'll have to see where that goes. All right. So Sarah, what else do you see some other kind of more problematic proposals that we've also seen?
Well, we've seen these before, but the one of the proposals is to make all pass-through income subject to either self-employment tax or the net investment income tax for taxpayers over a certain level of earnings above that 400,000. So passive income, S corporation earnings would all be subject to the net investment income tax, since they are not subject to self-employment tax. The other is to make the 461L, the business loss limitation, permanent. Right now, the Inflation Reduction Act extended it out until the end of 2028, but this would make that permanent. The second change related to that is currently if a loss is disallowed under 461L, currently it carries forward as a net operating loss, which allows that loss to offset any flavor of income you might have in the next year. But the proposal would say change that and not call it an NOL, but treat it as a business loss in the next year. So therefore, it could only offset other business income going forward. That would be a pretty significant change to taxpayers and how they're treating their losses currently. The other is some cleanup we saw in earlier bills in Build Back Better on digital assets, sort of refreshing the code to bring it up to include better definitions of digital assets, more encompassing. And that would include expanding the wash sale loss rules that would limit the ability for taxpayers that they have currently, it appears, to sell a digital asset, digital currency, an NFT, something, and then immediately buy it back very soon thereafter without having to wait for 30 days as one would if one sold a stock at a loss. So buying back in immediately if it was a stock or a security, you would not be able to claim that loss on the first sale. But in the case of digital assets, that is allowed. So this law would stop that as another potential revenue raiser.
Yeah. Digital liabilities, I think they should be called now.
Golden opportunities, I think, is what they like to be referred to as.
Okay. Well,
there's one other interesting point I would make, specifically given the Inflation Reduction Act of 2022 and really the movement by the president in the latter part of last year towards more of a green and clean energy, alternative energy, obviously significant expansion when we think about ITC and PTC for whether it's solar or geothermal or hydroelectric. But in the president's budget proposal, he increases energy taxes, including a repeal of expensing for intangible drilling costs and percentage of depletion for oil and gas wells. So, that kind of sends a strong message of where this president is headed. He also adds a new 30% tax, interestingly, to a comment that Sarah made, on electricity, which is used for digital asset mining. So you begin to see really where there is, to your comment, Brooks, a real significant divide, which is not by much when you think about, the polarization of, where this president and his party come from and where, Speaker McCarthy and the other party come from in the House with a very slim majority. So it's going to be interesting to see how all this shakes out and whether there really can be any movement in all of these various provisions that are in the president's budget proposal for 2024.
All right, Brian. So maybe a little good news on the international compliance front for individuals. Maybe. What are you seeing there?
So we're seeing on the individual side on passive foreign investment companies, it is a common issue that, you might find out later that you have an investment, you might have inherited an investment in a passive foreign investment company, and you failed to make what is known as a qualified electing fund election. And that essentially allows you to pick up the income currently, but you are normalized to pick up and tax at cap gains or ordinary rates. If you fail to make that election, what happens is you are hit with what is known as everything at the top marginal rate, and you have this excess interest, this excess tax on there that's an interest, they call it, but it's really just an excise tax essentially. And so you're paying at rates of 50% or more on the income of an investment in a foreign company just because you failed to make the QEF election, the qualified electing fund. So this proposal does allow one to go back and make a retroactive QEF election. Now, the trick there is because a lot of times you have to agree to keep your statute of limitations open for those years that you're going back. But it does appear that people are recognizing, and we see it all the time, that unsophisticated investors have just missed this QEF election because it's not automatic, and a lot of individual investors miss it. And so it would be a good thing from that perspective.
And we were talking about digital reporting. There's also a push to put digital assets on the FATCA report, the foreign asset report.
Right. Yeah,
not on a foreign bank account report, not on those FBAR reports yet. The Treasury is still thinking about that, but certainly they're winding up on this asset report, likely.
That's right. They haven't decided on the FBAR accounts yet. We'll see what they do there from the digital asset perspective.
Yeah.
And they continue to have a little bit of movement of trying to simplify the foreign tax credit for the individuals as well. But anyway, we'll see. All right. One last topic before we get into closing comments here. Where are we on the dreaded Section 174 research deduction add back capitalization fiasco, Ron?
Well, it's an excellent question. And there is certainly a significant amount of pressure being applied to both sides of the aisle. So for background purposes, when you have a research and experimentation expense since 1981, when the R&D credit was put into the statute, or the R&E credit, you have always been able to deduct your research and experimentation expenses for tax purposes. That, however, changed within the Tax Cuts Jobs Act of 2017 with a full understanding that was never to come into law. But unfortunately, it did come into law effective January 1 of 22. And now taxpayers, whether you claim the research and development credit under Section 41, you must capitalize and amortize over a 5 or 15-year period all of your R&E expenses. And Section 174 is a very broad provision, as we know. So it captures not only direct, but it captures indirect type production or overhead, SG&A type matters that taxpayers are having to capitalize and amortize effective January 1, 22. So fast forward, fortunately, there is significant bipartisanship support. The Senate had a bill introduced led by a Democrat out of New Hampshire and Senator Hassan. So you see broad support for this repeal specifically, as well as we saw two major voices on the Democratic side in the Senate, and Kristen Sinema, who's an independent out of Arizona, as well as Senator Feinstein out of California. So that bill has now been introduced. The repeal would go all the way back to January 1 of 22, with a general expectation that we could see a repeal in the third quarter of 2023. The House, which has even broader support in regards to this repeal, is scheduled to introduce a piece of legislation this week in regards to repealing the requirement to capitalize and amortize. And so very similar to the president's budget, we'll have to see what happens and see if that both pieces of legislation, whether it's on the Senate side underneath Senator Schumer or on the representative side underneath Speaker McCarthy, can move in a bipartisanship way to repeal 174, because there is significant pressure on the 118th Congress, and all senators, representatives, no matter who you speak to, have indicated, yes, this is something we must address. It furthers the disadvantage of the United States from being one of the innovators, if not the innovative country in the entire world. So good news last week, better news this week as we see both bills, one in the House, one in the Senate. We'll just have to measure it to see where it ultimately becomes law, hopefully and likely in the third quarter. So we're talking about a July, August, but prior to the 22 filing of any extended returns.
Yeah, that would be ideal, but yeah.
Unfortunately, not before people have to pay in their April 15th extension payments. But anyway,
Yes.
all right. I'm sorry, Brian, you were going to say something?
I was going to say, and that whole R&D idea is wholly in line with what they're trying to accomplish from a policy perspective with their international provisions, because you see that they have a 10% credit for onshoring jobs as long as you eliminate jobs. They want to eliminate export subsidies and the foreign derived intangible income, not just at the sales. They instead want you to create jobs and engage in R&D type activities in manufacturing development here in the United States. And so that's, I think it's incumbent upon them to get that passed, because it really is in line with what the current administration wants to accomplish if they're going to put this in their international provisions that they want to carve out and increase taxes on international operations.
All right. I think it is time for us to move to final comments. This is, these podcasts on this prospective Green Book type legislation is always very interesting for sure. So Ron, why don't you go first with your closing observations?
Well, thank you, Brooks. I think my closing comment on the president's budget it expands and creates, significant tax increases, which ultimately put the country really on a international global basis at a significant, I'll say, disadvantage. When we think about the R&D and the capitalization 174, at the same time, we're requiring capitalization amortization. We see other countries competing against us that are allowing a 200% deduction for, quote, R&E expenses and actually increasing their research and development type credits. So at the end of the day, what I would comment is that ultimately, when you think about what we're seeing in the president's budget, it is in fact a positioning type budget. We know we have a significant debate coming up with respect to our debt ceiling, and most people believe that the reason the president went all in as he did was really to position that he was calling for a $3 trillion quote reduction with respect to our 32 plus growing $1 trillion debt that we are facing from a country. But I thank everyone for attending today, and hopefully this has been informative with a lot of information there attributable to the president's 2024 budget.
And Brian.
I would say there's a couple of major points here. As we talked about the anti-deferral rules, the GILTI rules are set up to be essentially taxed at body corporates at 10.5% in the U.S. currently, and the Biden administration with the 21% tax rate on that, and the limitation on ability to take a credit, which is going to almost universally put you above 21%. I think that is like Ron says, the opening salvo. The OECD pillar is really at 15%. I think that's where people should look like ultimately where we'll probably land, not at 10.5, but closer to 15. I'd say 1. I would say something that is important in the international provisions we didn't talk about today. Remember, the international law change in 2017 tax law is the biggest change we've had since 1962. And there's a lot of new provision in there, and people are, finding ways to have tax advantages. And we are seeing quite a few loophole closures that are being identified by Treasury. And I think people should pay attention to those loophole closures, like some of the 338 transactions that are allowing sellers to get cap gain treatment on what otherwise would be individual. Some of the foreign partner transactions that are allowing them to avoid U.S. tax, some of those transactions that are out there in the marketplace, they are being identified, and I think we will see more of those loophole closures in the international provisions.
Excellent points. Excellent points. All right, Sarah.
I would say I am just looking at this smorgasbord of revenue raisers, and I would expect to see, if you're needing to balance a budget or a bill or pay for, that we'll see some of these items float back into future bills, where we might be surprised to see them show up. But they're going to be useful to help meet the requirements to propose balanced legislation for funding to report pay-fors. And so I'll be interested to keep my eye out to see which one of these come back, whether it's in this 2-year cycle of Congress, or it could be later. Once they're on the shelf, they can always be pulled down.
And for me, I agree with all y'all's comments. I am seeing this in the big picture, a kind of a defining political message by President Biden in the totality of let's go get the wealthy and the highest earners, the biggest earning companies and individuals, and make them pay their fair share. And I think different people can agree on what's fair, but clearly he's putting out an agenda, the increased taxes at at different levels depending on the provisions. But there's clearly a political message there that I think we will hear in the next election. Yeah, regardless of what gets through or what doesn't, he's put his stake in the ground that he's trying, what he's trying to accomplish here. All right, that's a wrap on this discussion of proposed tax law changes and President Biden's proposed budget. Thank you for listening in. Quick disclaimer that we are not providing tax advice on this podcast. Please consult with your tax advisor, hopefully at Cherry Beckert, with your specific tax issues or to discuss information from today's podcast. Check out the firm's website at cbh.com for the latest guidance and materials on this and other tax and business topics. This concludes today's podcast. Please like, share, and subscribe. Thank you, Ron, Brian, Sarah. Thank you, our listeners, for spending your time with us. We truly appreciate it. Let's call it a day and go forth in peace.